Hello, everyone, and welcome back to Your Finance TV. A happy Friday that it is. And we've got Jay Pelosky back with us. How are you, Jay?
Oh, happy it's Friday, Scott. How about you?
I'm very happy it's Friday. Everyone loves a good weather weekend, and that's what we've got ahead of us. So, you've been on Bloomberg TV this morning, but now you're coming onto your favorite channel to do a show. Your title, the musings, economics, politics, policy, and markets. Sounds very similar to a monthly rundown, but we did that last week. Let's jump into it. Let's talk about economics. And you talked about it a bit this morning. What did you say on Bloomberg TV about this morning?
Yeah, well, what's that saying? Deja vu all over again, right? I thought you were going to say that, but since you didn't, I figured I would. But yeah, so very much we did go on Bloomberg this morning, had a great discussion, talked about all the usual suspects, the Fed, our view of the semiconductor space and the AI age, et cetera. But what I really wanted to focus on today is kind of the political environment, which is generating a lot of headlines. And so I thought the spine of the monthly, which is our global risk nexus, which looks at climate, economics, politics, policy, and markets, would be a good way to kind of set up this musings. Drop the climate, because we just covered that last week, and talk about the remaining four. So let's start with the economics, and that's I think, actually the quickest and easiest one because things are good, right? I mean, if you think about our 4 for 24 macro surprises, right? Lower inflation sooner than expected. Certainly a check after the most recent US CPI data. Second surprise, better than expected productivity. Likewise, manifesting in the United States, less so in Europe and other regions, but certainly productivity growth over 3% over the last year through Q1 in the US is quite good. Third surprise, return to stability. Obviously, very visible with the move in the VIX indices, also inflation volatility collapsing. And then the fourth economic surprise, early cycle global economic recovery versus late cycle heading into recession. All of that, again, if you look at semiconductor cycle picking up, Asian exports picking up, European economy picking up, China growth worries dissipating, all of that suggests we are, in fact, in early cycle. So the economic data, and then by extension, the earnings data has been robust. And that is what is powering us through year to date with the S&P and ACWI both up double digits. It's basically because we've shifted from central bank and monetary policy focus to early cycle economic recovery and double-digit earnings growth focus.
Let's move on to politics. And I think it's pretty clear that I'm not the biggest fan of politics as it is anyway. But it's if you're just sitting back and you're just reading the headlines in the press, you would think the end of the world came in France this week as far as like elections and potential elections coming through. Run us through what's happening in Europe.
Yeah, no, I think that's a great segue. And let's remember last week we talked about politics, but it was much more U.S. politics and U.S. presidential election activity and campaigning. So here, yes, let's talk about politics. Let's talk about European politics. And I just think it's so interesting, right? It was the 10th European parliamentary election cycle going back to 1979. This now arguably, or not arguably, but this is factually the first since Brexit. So you can say the focus on the far right parties gaining ground, et cetera, is somewhat new. But this is for sure the first time I can recall that the European parliamentary elections actually generated, market-moving activity and market-moving issues. And I think it's really kind of telling that so much of the headlines have been about the far right making gains, far right, surging ahead. The reality is that the far right parties picked up roughly 20 seats, more than they had in the prior parliament, out of 720 seats. So there's 720 seats in the European Parliament. The far right gained an additional 20 their total, which is between a number of different parties, is less than a quarter of the 720. So to put it in context, the far right is not going to have any kind of leadership position in the European Parliament. They have not dislodged the centrist coalition. They're highly unlikely to impact the EC leader, Ursula von der Leyen's position as she seeks a second term. All of that is, needs to be put in context. So what happened is that the far right did do better than expected in France and in Germany. Now, even that would have probably not really generated much more than a day or two of kind of headline, except for the fact that President Macron in France called the snap election. And that prior point is validated when you look at what's going on in Germany, right? The German parties, the Social Democrats of Chancellor Scholz, they did even worse than the French parties. But yet we're not talking about that. Why? Because the Germans aren't calling a special election. So this is partly brought upon itself by the French president's decision to call a snap election, which, by the way, the first round will be held in 2 weeks. So that's one little insight into why the market action is so intense, because this is all being jammed together in a very short order, right? A week ago, there was nothing about a French election until Macron's term doesn't end, I don't think, till 2027. So years out. So no big deal. Now, all of a sudden, snap election, and by the way, snap election with the first round in 2 weeks, means the market has to compress a lot of stuff into that period. And so to kind of finish up, what that means is that the potential for the far right Marine Le Pen, which has been known, been a known factor in French politics for decades, her father for decades before her, is likely to gain ground in this snap election. The bet that President Macron is making is that it will force kind of a coalition between his party and the far right, which will kind of take the far right off the sidelines, being able to just say, oh, we would do this, and oh, we would spend money on that, and we would fix this, without actually having to do that, right? And that's partly why the market is reacting as it is, because the policies of the far right are very deficit expanding. In other words, they want to spend money they don't have. The French budget deficit is already over the European limit. And so this is why you see the action in the OATs, which is the French bond market, to a lesser extent in the stock market, primarily through the banks, which is interesting. The French banks have definitely taken 5-8% hit here over the course of the week. And so that's really what is the setup, that it happened quickly, that it reinforces already existing concerns on the budget deficit side, and it creates this anxiety of, okay, what's actually going to happen?
Let's move on to policy. And obviously, we've had some economic data out. Everyone thinks we've got inflation under control again, even though it's not under that 3 number yet. The bond traders are basically saying, yeah, we've got rate cuts coming. It's 2, maybe 3. All right. They always seem to be ahead of it all. Talk to us about policy, where you think we're going to be with this, and not only just the US, obviously, the rest of the world as well.
Well, yeah, before we get that, I did, just looking at my notes here, note that I forgot one point, an important point about the European elections, and that is where the far right govern, actually. So thinking about Hungary, right, and where they used to govern, thinking about Poland, one will see that the far right vote actually disappointed significantly. Viktor Orban, the leader of Hungary, his party got considerably less votes percentage-wise in this election than they did in the last European parliamentary election. The far-right parties in Poland did much worse than they did in the last election. So this kind of supports Macron's decision, namely that when the far right gets into power and has to make decisions, much as any government does, they become less popular. Excuse me. They become less popular. And so that is the bet that Macron is making. So, okay, enough on the politics. I think we covered that ground. On the policy side, what jumps out to us right away is how clearly this focus demarcates the shift from a focus on monetary policy to fiscal policy. Something we've been talking about at TBW Advisory for months and months, but just think about it. The fact that the ECB cut rates, the Fed had its meeting and changed its dot plot, and yet all we're talking about is the French elections and the European elections. So clearly, in the fiscal impact of the potential for a far-right party to get into power and to push for more spending. And so for us, some folks are talking about kind of a Liz Truss moment for French bonds, right? Remember Liz Truss, the very short-lived British leader who put together a fiscal package that blew up in her face and forced her to resign in very short order. I actually think it's interesting to contemplate all this European anxiety as a prelude to what might happen in the US in the next couple of months if it becomes the market starts to think and price in a potential Trump second term. Because let's remember the Trump policy mix, such as it is to extend the budget busting tax cuts, to install massive tariffs on imported goods, and to seek a weaker dollar. All of those are super inflationary and could lead to a significant upheaval in the bond market here in the United States that would make the French market action, very, very understated in comparison. So the other thought that we've had is that this really dovetails very nicely into what we discussed last week. Who will win the second half of the 2020s? Because it's all down to governance. It's down to the ability to expand your workforce. Here, the U.S. has a good edge up because of immigration, though it's a hot potato politically. It's very good economically. And then the other side of that is the issue of being able to bring together public finance, which is the fiscal side, and private capital to drive investment in semiconductors, EV plants, et cetera, et cetera. Those are the things that are going to determine who wins the second half of the 2020s. And in that note, you could argue that it's actually better for Europe to get this kind of stuff out of the way now than it would be to let it fester. And so for us, the policy thing is really, it cements the reality that the driver going forward is not monetary policy. It's not what the Fed is going to do. It's the fiscal side of things. And who can best drive investment spending to fund the AI build out, to fund the EV build out, to fund the semiconductor build out. Who can best do that without creating anxiety and upheaval in the bond market?
So, not that this is a monthly, but we always wrap up monthlies with markets, and obviously we're going to look at that now. Like we talked about, like India and Mexico before, about the disruption happened in their elections. Markets took a hit. I just had a quick look here. Like India's actually small up since then, and Mexico's essentially flat. So it was just like a blip on the radar. Like obviously we've talked about the politics side, but like what are you seeing for markets going ahead, the potential volatility from elections and other news that's coming through as well?
Yeah, that's exactly where we want to go. And I think it is interesting, right? So let's start with the US, right? The 10-year treasury at 4.2%. It's rallied roughly 25 basis points over the past month as the Fed, as inflation come in and the Fed has signaled that it feels relatively good about things. All that makes sense. right?
Yep.
The surprise is that the European bond market, as referenced by the Bunds, the German Bunds, has also rallied 20 basis points over the past month, due in part to the ECB cutting rates just recently. Now, here's where it gets interesting. France, okay, which is the epicenter of all this political angst, over the last month, their 10-year bond has widened out, okay, so not rallied, widened out a whopping 8 basis points, Scott. 8 basis points. So for all the headlines, all the stuff, we're talking about 8 basis point move in the French bond market over the last month, okay? The other issue that people love to talk about is the spread between the German bonds and the French bonds, which truly, which has widened out, maybe 40 or 50 basis points. But here's the thing. The French 10-year bond yields 110 basis points less than the US 10-year. In other words, it yields 3.1%. So, you know, for all the fuss and furor, you would think that the 10-year French bond must be yielding 5%, 6%, 7%. It yields 100 basis points less than the US 10-year, has widened out a whopping 8 basis points in the past month. Now, the bond market that folks really usually focus on when fiscal issues arise in Europe is Italy, right? The Italian bond market is always the one people look to see what happens. Okay, there, the Italian bond market has widened out a whopping 6 basis points. 6 over the past month. And the spread between the Italian 10-year and the German 10-year has, again, yes, widened out to 150, 160 basis points. Okay? Sounds like a lot, but the reality is that when the market really gets worried about Italian fiscal profligacy and ability to maintain its budgetary rigor, that spread usually is 300 basis points. So double where it is today. All of this is to suggest that, you know, the market reaction is not commensurate with the headline reaction. So to us, it's really interesting. You would think, similarly, let's turn from the bond market to the currency market. You would think that the euro must be getting blasted, right? We've heard so much about King Dollar and a dollar wrecking ball, and we're on the opposite side. Fair notice. We are not dollar bulls. We are dollar bears. So you would think, though, irregardless, that the euro must be getting just bludgeoned, right? No, the euro is actually up over the past month, up. And so the US dollar, the wrecking ball, the US dollar is up, let me just check my numbers here. US dollar is up 4% year to date, 2% over the past 12 months, and a whopping 0.5% over the past month. So again, all this talk, the dollar is up 0.5% over the last month. I mean, what are we getting our shorts all twisted about, right? I'm sure you Aussies have a phrase for this, but you know, don't get your knickers in a knot is the one that I remember. So it just doesn't make a whole lot of sense, basically, to us. You know, there's a lot more smoke than fire, even in Mexico. Okay, Mexico has had a pretty aggressive reaction. Peso's down about 10%. But that's not really because of, you know, massive uncertainty, though uncertainty has increased. It's because the peso is the most favored carry trade in the world. And the peso actually was the best performing currency versus the dollar over the past year until this episode here over the last couple of weeks. In other words, it was massively overowned, and now everyone's getting out at the same time. So you have a 10% move in a week. Boom. Is it going to continue? Highly, highly unlikely, in our opinion.
Jay, thank you so much for these musings. As always, I really appreciate them. And the Aussie, well, you got some more for us?
Yeah, we're not done. What about the model updates?
Oh, I'm
Didn't we talk
sorry.
about that, buddy?
And I love talking about models.
You're not on your A game today. You have your A game shirt on, but I don't know about here.
That's all right. So give us some model updates.
So we did, in fact, through all this, we're updating our model portfolios as we do, every month. And it's an interesting time. So what is TPW Advisory doing with all this angst about the politics and all this uncertainty flying around? Well, we're not doing a ton. We're not changing our Mexican allocation. We own EWW. We're not changing our European allocation where we own EUFN. We talked about the French banks getting whacked. EUFN is taking a little bit of a hit, but it's massively outperformed year to date. So one can say it's just giving some of that back, and that happens in markets as it does in life. What we are doing is we are continuing to invest in our main theme of fusing the digital and physical space through the powering of the AI factories, also known as data centers. So we're continuing to invest in that theme. And the other step that we've made, which we think is interesting, this is for our global multi-asset model, is we're taking our first position in U.S. commercial real estate. We think, much as we've made the case in our two tech stack divide thesis, that the risk reward is appealing in China tech, we think the same thing is the case now in U.S. commercial real estate. Yields are double digit on many of these instruments, so you're getting paid. You're seeing transactions start to appear, which suggests that the market is starting to clear. Everyone focuses on, oh my God, the discount to the last time this property sold is 50%. That's not the right thing to look at. The right thing to look at is that transactions are happening. In other words, people have come together, buyers and sellers. Someone's going to take a hit, yes, but things are moving. And then the last point that kind of led us to this decision was the regional bank index in the US, right? Again, everyone talks about the massive property ownership or property lending book in the regional banks. But what people don't talk about is the fact that the regional bank index bottomed months ago. Months ago, it's bottomed. It's well above where it was 2 and 3 months ago, 4 months ago. So all those things put together suggest that the risk reward is reasonably compelling. You're getting paid to wait with double-digit yields, and if there's any pickup, which there may well be, given that rates are coming down, right? The economy is robust, no sign of recession. So gradually, that commercial, that office, that multifamily, all that stuff ought to gradually see adoption, and you could get some capital appreciation for a double-digit return over the next 12 months. We think that's pretty decent. So we made our first foray there. And then to finish up, the one thing we did in our TPW20 thematic model is that we added to renewables. This is much like the commercial real estate story, right? Over the last couple months, story after story about solar companies getting hammered, about solar prices collapsing. And we've talked about that in some of our work when we talk about climate in the monthly. It's definitely the case. But again, we want to listen to stocks, not Vox, and the stocks are telling us that they're bottomed and they're going up. In fact, the renewable ETF has been the best performer in the entire climate space over the last month and the month before that. So that tells us something. That tells us that, again, notwithstanding all the super negative stories, it is in the price. It is in the price, and the market is starting to look ahead to better times. So we added to renewables in our thematics model. So in a way, we're actually arguably taking on a little bit more risk. Stepping into commercial real estate in the US, adding to renewables in our thematic model. We do not believe the sky is falling in. We continue to think that we have the right view with our global macro blue sky outlook for 2023 to 2027. And we think all this political anxiety in Europe will blow over in the next couple of weeks, particularly once we get through the snap elections in France. And in the interim, European economy is recovering. European earnings growth is accelerating. Same in the US, same in Japan, same in China. And with earnings accelerating, we really don't see a lot of downside in risk assets like stocks.
Well, let me try this again, Jay. Thank you very much for your time this week.
A pleasure, Scott, as always, buddy.
You have a great weekend, okay?
You as well.
For everyone else out there, good luck investing.